So for decades, science fiction has basically been making us this huge promise, right?
Right. Yeah, the whole flying cars thing.
Exactly. We were supposed to have flying cars by now. And if you look at the marketing materials for Joby Aviation, you'd honestly think the future has finally arrived.
It really looks like it. I mean, electric vertical takeoff and landing aircraft, zero emissions, just whisking people right over gridlock city streets.
It sounds completely incredible. But as of today, April 22nd, 2026, if you actually pull up Joby's stock ticker, which is JOBY, the future, looks a lot less like the Jetsons and, well, a lot more like a classic retail trader trap.
Yeah, it is a massive paradox right now.
Right.
Because on one hand, the stock recently surged on this new artificial intelligence airspace deal, and they are sitting on these massive partnerships with heavyweights like Toyota and Delta.
Which sounds incredibly bullish.
It does, but then you zoom out even slightly and you see the stock has plummeted 44% in just the last 6 months.
44%. I mean, the technicals are flashing sell signals across the board, but then you have some Wall Street analysts out there aggressively defending the stock, claiming it's actually significantly undervalued.
Right, which makes it super confusing for anyone looking at the chart.
Totally. And here is the real kicker, the detail that makes this a real high-stakes mystery, honestly. In the last 90 days, company insiders have quietly dumped nearly $70 million worth of their own shares.
Which completely scrambles the narrative, you know?
It really does. So what is actually going on here? Is Joby the future of global transportation, or is it just a financial sinkhole waiting to collapse?
That is exactly what we need to figure out.
Yeah. So before we rip into the financials and those crazy insider trades, I want to quickly ask you, our listener, to hit the like button and subscribe to our YouTube channel.
And it is honestly compulsory that you leave your comments and feedback below because we want to know exactly where you stand on this stock as we unpack all this data.
For sure. Drop your theories in the comments. And as we dive into that data, the balance sheets, the charts, the analyst reports, we do need to establish our baseline rule here.
Right. Very important. This is a natural human debate and an analysis of the provided source material. We are looking for patterns and mechanisms, but, you know, this is strictly an educational deep dive, not financial advice.
Exactly. You always have to run your own numbers.
Always.
But let's actually start with those numbers. We need to somehow reconcile the futuristic promise of electric aviation with the cold, hard reality of yesterday's closing price.
Which was $8.97.
$8.97. So to put that into perspective, Joby is currently carrying a market cap of roughly $8.79 billion.
Yeah. But that 52-week range, I mean, it tells a story of some violent sentiment shifts.
Oh, absolutely.
Yeah.
The high was $20.95 and the low was $5.61. We are like hovering dangerously close to the floor of that range right now.
Which is pretty wild when you look at their last earnings report.
Right, the Q4 2025 income statement,
Yeah.
They showed revenue of $30.84 million. And analysts, they were only bracing for $16.88 million.
It was a huge beat. If you just read the headline, you would totally assume Joby is scaling brilliantly.
Right, but when you look under the hood, they didn't make that money from their core product at all. They haven't even officially launched commercial flights yet.
No, they haven't. That top-line beat was driven almost entirely by military contracts and also revenue they absorbed from their acquisition of Blade Air Mobility.
So it's not organic growth. It's like, well, it's like bragging about your new bakery's record profits, but all the money actually came from selling the delivery vans you bought last year.
That is a great way to put it.
You know, you aren't selling bread yet, and the bread is the whole point of the business model.
Exactly. And taking that bakery analogy a step further, you're selling those delivery vans while operating the bakery itself at a staggering loss.
Right. How bad was the loss?
The full year 2025 net loss was negative $929.84 million. Yeah, they lost nearly $1 billion in a single year. That leaves them with a trailing 12-month EPS earnings per share of negative $1.13.
So for every share of Joby floating around at $9, the company basically bled over $1.
Exactly. But the bulls always point to the balance sheet to defend this.
Sure, the war chest. They had total assets of $1.79 billion at the end of 2025, right? And that included $1.4 billion just in cash.
Right, and they didn't stop there. They raised another $1.2 billion in the first quarter of 2026.
So they are sitting on a $2.5 billion war chest right now. I mean, that has to count for something, right?
It counts for survival, absolutely. Because for pre-revenue tech and aerospace companies, the biggest threat to investors is usually sudden shareholder dilution.
Right, where the company just desperately prints new shares to keep the lights on, and that completely craters the stock price.
Exactly. So having 2.5 billion in total liquidity, that minimizes that immediate dilution risk, which is a huge plus for the bull case.
Okay, but liquidity is only a defense mechanism if your burn rate is actually under control.
And it absolutely isn't under control.
Not at all. The annual cash burn for 2025 was $539 million. And now, their projected burn for just the first half of 2026 is between $340 million and $370 million.
Yeah, so the burn rate isn't just high, it's accelerating.
Why is it speeding up so much if they aren't even flying commercially yet?
Because regulatory waiting games are notoriously expensive. Every single month, they wait for the Federal Aviation Administration to grant certifications. Joby is paying thousands of top-tier aerospace engineers.
Right, those salaries don't pause.
Exactly. And they are leasing these massive manufacturing facilities that aren't producing sellable aircraft yet, plus maintaining corporate overhead.
So you basically have hundreds of millions of dollars in inactive capital just burning away while the federal bureaucracy churns.
Yeah. That accelerating cash burn is a ticking clock. And when you look at the daily charts, you can actually see algorithmic traders pricing in that exact lack of time.
Let's talk about those charts, because the technicals are basically confirming a structural long-term downtrend.
Oh, absolutely. The stock is currently tracked below both of its major moving averages.
Yeah, it's sitting under the 50-day moving average at $9.42.
Yeah.
And it is just miles below the 200-day moving average, which is way up at $13.67.
So it's essentially walking a tightrope right now. The sources show key support is hanging by a thread at $8.31.
And if it breaks below that 8.31 level,
there is very little historical price memory to catch the fall. And immediate resistance is right overhead at $9.23.
right, so it's boxed in.
Mm.
And it would need a breakout above $9.93 to even begin a structural shift back to a bullish trend.
Which doesn't look likely at the moment because the momentum indicators show a market completely paralyzed by indecision.
Yeah, the RSI, the Relative Strength Index, is hovering in no man's land between 51.57 and 54.34. So the stock isn't overbought and it isn't oversold.
But the mass ED is where it gets genuinely confusing, honestly.
Yeah. I was looking at the data, and some trading platforms are registering a slight buy signal at 0.045, while others are simultaneously throwing a sell signal at negative 0.39.
That's weird, right?
How does the exact same mathematical formula spit out two completely opposing signals at the exact same time?
So it comes down to how high-frequency trading algorithms and different charting platforms sample data in these highly volatile, low-conviction environments.
Okay, break that down for me.
Well, the MEXC calculates the relationship between two exponential moving averages, right?
Right.
Some platforms sample tick-by-tick intraday data, while others weight their formulas heavily on the daily close.
Oh, I see.
So when a stock is whipping around in a super tight channel but essentially going nowhere, the intraday math can trigger a fleeting buy, while the macro daily math is screaming sell.
So the algorithms are basically just tripping over each other.
Yes, exactly. And it creates what traders call a compression phase.
A compression phase. What does that actually mean for the listener who's watching the charts right now?
It means volume is drying up. The average 10-day volume has shrunk down to about 20.25 million shares. And the daily price movements are getting tighter and tighter, moving sideways in this microscopic range.
So volume is shrinking, the price is trapped. It sounds like a coiled spring.
It is.
But who is doing the coiling here? Because the sources point to massive liquidity demand zones sitting way down between $6.96 and $7.48.
Institutional money is doing the coiling. This right here is why retail traders constantly get slaughtered on speculative tech stocks.
Yeah, explain that mechanism.
Well, a retail investor sees a stock down 44% from its highs, right? It's trading at $9, and they assume they are buying the dip on a revolutionary company.
They think it's a huge discount.
Exactly. But institutional algorithms don't buy the current price. They hunt for liquidity.
Stop loss hunting.
Yes. Those zones between 6.96 and 7.48, that's where massive blocks of institutional buy orders are sitting. The big players know that if they just let the price slowly bleed, eventually it triggers the stop-loss orders of all the retail traders who bought at $9.
Oh, that is brutal. So the retail traders panic. Their shares are automatically sold at a loss. The price spikes downward into that $7 zone. And the institutions just scoop up millions of shares at a massive discount.
Exactly. They basically let the retail traders act as the liquidity providers for their own entry points.
That is a completely brutal mechanism. But, if the algorithms are patiently waiting for a drop, it seems like the people inside the building might be too.
Oh, you mean the insiders?
Yeah. Let's look at the analyst consensus and the insider changing data, because this is where it gets crazy.
Well, Wall Street is predictably split, but the consensus definitely leans toward a cautious reduce.
Right. Out of the analysts covering Joby, there are 2 buys, 4 holds, and 3 sells.
And the price targets reflect that exact same split reality. The low target is $7, which honestly aligns suspiciously well with those institutional liquidity zones we just mapped out. Seriously, that's a crazy coincidence.
And the high target is $18, with the average landing at $13.81.
But I have to be honest, analyst targets feel like total background noise compared to what the insiders are doing right now.
Yeah, this is the bombshell of the entire source stack.
It really is.
Yeah.
In the last 3 months alone, 8 different insiders unloaded $69.7 million worth of shares. A nearly $70 million exodus of capital from the exact people who see the daily test flight data.
And the timing is what makes it feel so aggressive. CEO Joby Aviation sold shares at approximately $9.03 just last week, on April 15th, 2026.
Right.
I mean, if you're the CEO of a company that supposedly holds exclusive rights to launch commercial flights in Dubai this year, and you have strategic backing from Toyota and Delta, why on earth are you cashing out at $9? The stock was touching $20 less than 12 months ago.
I get it, but we do have to view insider selling through a few different lenses before declaring a total panic.
Okay, play devil's advocate for me.
Well, executives receive massive blocks of stock options as their primary compensation, right?
Sure.
When those options vest, they trigger massive tax liabilities. It is incredibly common for executives to file scheduled 10b5-1 trading plans.
Right, the automatic sell-offs.
Exactly. Those plans automatically sell a portion of their vesting shares strictly to cover the tax bill. It takes the emotion and the optics of insider trading completely out of the equation.
Okay, I understand the mechanics of 10b5-1 plans and tax harvesting. But nearly $70 million across 8 different executives in just 90 days.
A lot.
And with the CEO personally selling near a 52-week low, you don't program a blind algorithmic sell-off at the bottom of the chart if you genuinely believe a historic, revenue-generating launch in Dubai is just months away.
Look, I will concede the optics are abysmal.
Yeah.
Even if every single share sold was legally scheduled a year in advance, the market interprets $70 million in insider sales as a glaring lack of conviction.
It has to. It forces institutional investors to question the internal narrative. They look at those sales and wonder if the internal timeline for success, specifically regarding the FAA certification, is significantly further out than the company is projecting publicly.
Which brings us to the ultimate valuation debate here. Is Joby Aviation a classic value trap, or is this literally the chance of a lifetime to buy a piece of the next transportation revolution for the price of a fast food burger?
The divergence in how analytical models price this company is honestly staggering. It's like appraising a house that hasn't been built yet on an earthquake fault line.
That's pretty accurate. Simply, Wall Street's models claim the stock is currently 25% undervalued, assigning it a fair value of $12.14.
Right, so that would be a solid margin of safety.
But then you cross-reference that with alpha spread. Their models aggressively disagree, labeling the stock 83% overvalued and calculating an intrinsic value of a mere $1.61.
$1.61. It's like valuing Schrödinger's cat. It is simultaneously a multi-billion-dollar aerospace empire and a bankrupt shell at the exact same time.
And we won't know which one it actually is until the FAA opens the box. The FAA is the entire mechanism driving that valuation gap.
Let's unpack the bull case first then. Joby is currently about 70% of the way through Stage 4 of the FAA certification process, right?
Right. And Stage 4 is the testing and analysis phase.
But the term testing doesn't quite capture the severity of it, does it?
Not at all. Stage 3 is mostly just engineering plans and design agreements. Stage 4 is where you actually have to put the aircraft through physical destructive testing to prove it meets the safety standards you agreed upon.
Oh, wow. Like what kind of testing?
They have to prove the software has multiple layers of redundancy in case of a mid-air reboot. They have to prove the battery packs won't experience thermal runaways during the massive energy draw of a vertical hover.
So it's incredibly rigorous.
Yeah.
But the bulls argue they are 70% done with that gauntlet. And they have the $2.5 billion in cash to fund the rest of the testing.
Plus, they are targeting that late 2026 launch in Dubai, and they've actually issued 2026 revenue guidance between $105 million and $150 million.
Okay, so if they hit those targets and capture the expected early market share, the bullish financial models project the stock could blast past $20 by 2029.
That's the best case recovery scenario.
Mm.
Now open the other side of Schrodinger's box, the bear case.
Glad to hear it.
Aerospace historians will tell you that the final 30% of FAA Stage 4 certification is where next-generation aircraft projects go to die.
Really? Why the last 30%?
Because finding one flaw at that stage doesn't just mean rewriting a document. It means redesigning physical hardware.
Oh, man.
Yeah, if the FAA determines, say, a specific rotor component suffers from acoustic fatigue earlier than projected, Joby has to engineer a new component, manufacture it, integrate it, and rerun months of testing.
And suddenly, that late 2026 Dubai launch slips into late 2027 or even 2028.
Exactly. And while they wait, that $370 million 6-month cash burn continues unabated.
Unabated. If certification delays stack up, they will chew through their massive cash reserves without generating a dime of organic revenue.
Which is exactly why Alpha Spread's 1.61 valuation makes sense to some. It's heavily weighting that current negative EPS and accelerating cash burn, assuming the timeline stretches out.
So in a worst-case continuation scenario, models predict the stock could bleed down to $5.57 by the end of this year.
Because traditional discounted cash flow models completely break down here.
Right.
You can't project future cash flows when a single federal agency has the power to either greenlight a global industry or stall a company right into bankruptcy.
So when we synthesize all of this, the financials, the algorithmic chart setups, the insider selling, and the massive regulatory hurdles, we arrive at a very polarized outlook.
Extremely polarized.
Give me the timeline breakdown. What are the mechanisms driving the next few weeks?
Short term, over the next few weeks, expect the stock to remain trapped in that compression phase we talked about.
Just trading sideways.
Sideways or with a slight downward bias toward that 7.29 to 9.33 range. Because the technicals are weak, institutional algorithms are hunting for lower entry points, and the $70 million insider sell-off has pretty much neutralized any retail buying momentum.
Right. There is zero immediate catalyst to drive a breakout above 9.93.
Exactly.
And what about the macro view, looking out from 2026 to 2030?
Long term, it is a strictly binary outcome. If they survive the final 30% of Stage 4 without a redesign, launch in Dubai, and activate their Delta and Toyota networks, the $20 plus price targets become highly realistic.
But if they don't?
If the FAA timeline stretches, the cash burn becomes terminal, leading to severe shareholder dilution and a slow, agonizing bleed into the $5 range or worse.
Which brings me back to the detail I just can't shake, the insider data. We know the entire bull case, the path to a $20 stock, relies entirely on getting through the final brutal phase of FAA testing and launching in Dubai later this year.
That is literally the sole catalyst that matters.
Right. So if the CEO is willingly selling his own shares for $9 today, while simultaneously telling the public that the historic Dubai launch is right around the corner, what does he know about the FAA that we don't? Are the public projections actually aligning with the private realities behind closed doors?
That is the big question, and it's the question every single investor has to answer for themselves before allocating capital here.
Absolutely. And we want to know your theory. Is the CEO just executing a scheduled tax plan, or is he quietly grabbing a parachute before a massive certification belay is announced? Drop your analysis in the comments right now. Make sure you hit that subscribe button, like the video, and keep questioning the data. We'll see you on the next deep dive.